Hello everyone, can you hear me? Just want to make sure that you could hear me. I had some trouble logging in, got disconnected, came back in. I just want to make sure we didn't drop everybody. And I wonder if we can make video work tonight. That's pretty ugly, huh? Well, not just my face, watch it. All right, looking good. Everybody's video loading at an adequate speed, I hope. If not, we don't have to use it. It's up to you. Great. Now, everybody see the PowerPoint, I hope? Everybody good to go? Thank you, Brian. Awesome. Thank you for joining me tonight. Sorry I was on a couple of minutes late. Back to the regularly scheduled time. That's pretty good. I'm pretty happy about that. And tonight I'm back in Addison, my hometown, which is in North Dallas, as you know. And tonight I would say 3 or 4 things. Probably the most important to you was the last one, but I would just say go Lions. I think our athletic teams are in full swing. I think soccer's going on. Volleyball, I would assume cross country by now, and clearly our football team is exceeding a lot of expectations. They're a lot of fun to watch, and you get to see the band, you get to see the cheerleaders, you get to see the football team. It's a great time. In fact, even tonight I happen to have my A&M Commerce mug there. I don't know if you can see it or not with that reflection on it, but anyway, cool. Happy to have you. 2, we've had a bunch of people that have had some issues getting their functionality working with the website and being able to see class live and things. So I think we have that all settled out. I've been somewhat lenient related to homework, people that were having issues or reported issues, but now it's time for all of that to be over. So, you know, no more late assignments unless you've been given permission in advance for it to be late. And if you do get permission in advance, it's no big deal, but if you wait until it's afterwards, the answer is no. You know, you've had an entire week to do it, so you know, let us know in advance if you're not going to make it. The next thing is this week's homework. It's not hard, but it is another Excel spreadsheet, and it probably takes a little bit of understanding if you haven't done anything like this before, and I will show you how to do the homework at the end of the lecture. So it's in there. If you want to know how to do the homework, it's right there for you. Now the key here, however, is when you turn that in, you must use the formulas in Excel. You cannot just put the number answer in there and expect to get credit. If you put in just the number and not the formulas, the answer is wrong. Right? So we're trying to get you folks to use Excel for this kind of stuff. And it's really super simple. Shouldn't be a problem. Okay. Also, there's some taxes out there. We have a whole separate lecture, so I don't know, maybe 15 minutes or something really quick, from Toby Moon, who's a tax manager at Dasky, and he just posted a really succinct overview of taxes for you, and I highly recommend that you spend the 15 minutes watching that. Also, the bank talks about free cash flow, and I do run into this term. The book talks about real cash flow, and I do run into this concept constantly. Last week you may not know, but I was on Wall Street and raised a significant amount of equity capital, and free cash flow is something that comes up. Most people would calculate it by, they're just trying to look at GAAP financials and trying to understand what the real true free cash flow of the business is, not the statement of cash flows, but what is in the finance world called free cash flow. Most people take EBITDA minus capital expenditures to see what the free cash flow of the business is available to do whatever they want to do. But I actually have a very slightly different view, because I think the right way to look at cash flow is if you could just take EBITDA and then subtract any cash taxes paid, because remember, in GAAP statements there's not necessarily a correlation between the taxes that are displayed on the GAAP set of financials and what you actually pay in taxes. So if I'm trying to get the free cash flow, I want to know EBITDA minus cash taxes paid minus how much did I have to pay in interest, right? And then if I had any capital expenditures that weren't financed, what's that? I'm not trying to get you to remember this formula. Just want you to remember the concept of EBITDA minus CapEx is the way most people look at it. If you want to get even more granular, even more precise, you would do it that way. Okay. Now, on to Chapter 4 and the analysis of financial statements, which I know you're just dying to get into. I know you just can't wait. So the point is that ratios are not just a pile of numbers. They really matter. They're used every day in business, and they're extremely important. And they bridge the gap between the kinds of things we talked about last week when we were talking about trying to interpret what a financial statement says, because it only tells you so much, and there's a lot of things that it just doesn't tell you, and you need to take them and do something with those numbers to understand them more importantly. And once again, you're going to hear this from me a couple of times tonight, which is, look, when it comes to these ratios, you don't have to try and memorize the formulas. I want you to understand the meaning and the concept, because you can always go back to the book and figure out how to do the actual calculation. I want you to understand why it's there and what it means more than how to calculate it, even though the homework is how to calculate it. So on the ratios, you know, there's this old saying in business that what is measured is managed. I would say what is measured can be managed would be the way I would say it. But it's really important to look at ratios. And similarly to a set of financial statements, like last week we talked about, they're always shown in a trend that they're done appropriately, because if you just have one set of financial statements, I can't tell you. So really you need to see it over a period of time. It's the same for ratios. If you can see the ratios happen over time, it will tell you a lot. And they will tell you a lot about the past, they'll tell you a lot about right now, and they can tell you a whole lot about what is likely to happen in the future. And they also are very useful in benchmarking. And in the operating side of a business, one of the hardest things to get is really good benchmarks, because really what you want to know is how you're doing against your competition, right? Or how you're doing against the industry average. In some cases that may be available to you, in some cases they may not. So that's why a lot of people would benchmark internally year over year versus budget, East Division versus West Division, whatever they can do, but they will always use ratios to try and interpret what the financials are telling them. So, you know, why would ratios be useful? Well, they help you standardize the numbers in some way, and more importantly, in my mind, they help you facilitate comparisons, because back to that last notion of benchmarking, it's the same thing. Benchmarking is really comparing, and it helps you understand what you're doing well and what you're not doing well, and more than just straight numbers on a income statement or a balance sheet. So if you know it, they're always going to be different based upon what industry you're in, what stage of life of your company is. Are you a big company, small company, public, private? But, you know, it should be able to, when done right, be able to highlight your weaknesses and your strengths by looking at the ratios of the company. And once again, it should be made over a period of time, and if at all possible, with the information you have that you think your competitors have, or your comps, you know, comparable companies, comps that your finance word of the week, comps, you know, what the comps are, and so you would want to know the trend, you want to know about the industry analysis, and then the peer analysis, or comp, so to speak, right? So who would use these things, really? Yeah, it sounds cool. A bunch of finance wonks guys, a bunch of numbers guys all out there trying to figure out, you know, something, but who really uses them? Well, let me tell you, a lot of people will use them. Bankers use them. People lending you money, whether that's a banker or Wall Street or a bondholder, they're going to use them. Suppliers, the people that you're getting your raw materials from, clearly are going to use them. And financial analysts, your internal financial analysts, when you're trying to look at your company and seeing how well you're doing or how you could improve or where you're failing, the internal folks are really going to take a look at that. And then externally, particularly in public company situations, they're going to take a long, hard look at the ratios as they try and compare you to what they think you should be able to achieve or what they think your peers or your comps should see. And frankly, probably the people that use ratios a great deal are the managers. So, how many mechanics per truck do you have in your business? How many loads of concrete are coming out of that plant per day? What's my tonnage of output? And then lastly, probably a different set of ratios would be used by the people that actually own the business. Now, each one of these groups of people would use a different set of ratios, perhaps, to help them determine what their view of the business is based upon their view, because clearly your lender is going to be looking for something different than your owner, which is going to be looking for something different than your managers are looking for when they're trying to run the business on a day-to-day basis. So what do bankers use ratios for? First of all, I just want to make sure you can pay them back, right? And so they would look at how much you earn versus how much you have to pay them and see if that's an irrelevant ratio for them. And I think I talked about it last week on the fixed charge coverage. So they're going to want to see what your charges are for paying all that debt service, but they want to see that your earnings are higher than that. So one, they're going to want to look at your ability to pay the loan back. Also, a ratio that a banker would use is much like I alluded to last week on the buying a house. If you're buying a $100,000 house, you might put $80,000 down, and therefore you have an 80%, and it's a $100,000 value of that home. It's essentially an 80% loan to value. They loaned you 80% of the value. It's an 80% LTV, so loan to value. So clearly, bankers that are loaning on those kinds of assets are going to look at the value of the collateral, and guess what? They're not going to loan you 100%, right? They're going to loan you some percentage of the value of those assets, certainly not 100%, because they need to have a cushion in case something bad happens. Market turns down if it's real estate, markets go down, markets go up in real estate. What's the protection there? And frankly, if you quit paying them, you don't pay them for 3 or 4 or 5 or 6 months, and they've got to come foreclose on the house, and then they're going to market it, and then they got to sell it. So they have to have a cushion in there. So they're going to try and determine what the loan to value ratio is. It happens in every transaction of that type. They're also going to use them for the covenants I talked about. So that's more trying to make sure that you have the ability to pay the loan back. So they may have a covenant, which means you're assuring the lenders that you will stay within certain financial parameters. You won't have too much debt as opposed to your earnings. You'll have so much ability through your earnings to pay the bank loans back, that kind of stuff. So the covenants are used no matter what. The covenants are used, the ratios are used to determine covenants, and every quarter, for example, we would send a covenant calculation to our banks telling them that we are in compliance, and here's a calculation of our covenants, and here are the ratios. It happens quite frequently all the time. Suppliers, they're just trying to figure out if you're a worthy credit. So if you are making, back to my cabinet making example, if somebody's supplying you the wood, the glue, the nails, the paint, the whatever, do you have sufficient credit quality to pay them back? So they're going to use ratios to figure out how able are you to actually be a good customer for them. Now, once again, the financial analyst have a couple of things. They're trying to figure out internally, how do we get better? Really pretty much it. And how, we use numbers to be able to determine how we could get better. We would also use numbers to evaluate projects to see if it was, let's say somebody wants to build, we're selling Dr. Pepper in Peru, but we're not selling it in Ecuador. Should we build a plant in Ecuador to sell Dr. Pepper? I don't know. Somebody's going to have to do the numbers, and somebody's going to run some ratios on it to see how it would compare to other past experiences. So clearly, they're going to use it to improve. They're going to use ratios to see actually how we're doing or meeting expectations. You would think it was just the budget, but no, these things are quite frequently used. And then once again, the external analysts, for example, there's 4 people out there that publish research on my company telling everybody what they think we're going to be able to do and what our profit margins should be, and therefore they use that as a way to kind of predict what they think our stock price should be worth in the future, and they will use ratios as part of that evaluation of us, and it will help them set expectations. Managers, obviously, I'm looking at these because I want to drive the performance of our companies and help them improve. And clearly, ratios different. I use different ratios than say a supplier would, but clearly we're using ratios to do that. And the owners of the business want to know, hey, how profitable I am, but ultimately they typically would want to know, what's the value? So we're going to use ratios to try and determine what the business is worth. I'll show you some examples of that a little later. So there are 5 major categories of ratios, but we could go on and on and on. But the 5 we're going to talk about tonight are liquidity, how much available cash and cash-like do you have to operate the business? Assets, so how are you managing your assets appropriately? And then debt, we've talked about that a little bit, but how well are you managing your debt? Are you doing that appropriately? Profitability, are you as profitable as you should be? And then lastly, what's the market value? So if you think back to some of these other slides, bankers, liquidity. I'm going to look at it for asset management, debt management, profitability. That'd probably be managers. Market value would probably be owners. So if these are the categories that we're working in, what are they trying to look at? In other words, what questions are they trying to answer? And liquidity means, can we make the payments? Really, do we have enough cash to operate the business and pay the obligations of the business, whether that should be to pay our payroll, our suppliers, our bank, whomever? Do we have sufficient money to do that? Because sometimes you might build a cabinet and then you sell a cabinet and then you have to invoice that and then you have to collect on that, and that takes money. So do you have enough liquidity to handle your business in the middle of all that? Because it's not just as simple as I sell something, I get paid, and therefore I pay those people I owe. Those are not in synchronicity. They're not completely entirely linked up. It'd be perfect if the world worked that way, but it doesn't. So asset management, do I have the right amount of assets for it versus our sales? So for example, my example of the Dr. Pepper plant in South America, should we build a new Dr. Pepper plant there? Are we right? Do we need more? Do we have too much? Should we cut back? If you would think about a retail store that you go to, a clothing store, do we have the right amount of inventory on the shelf? Inventory would certainly be a big element of asset management. In my business, in the trucking business, certainly we're trying to determine, do we have the right number of trucks available? Do we have too many trucks? Do we have not enough trucks? What's the right thing? Do we have the right kind of trailer? Do we have the right amount of trailers? Do we have them in the right place? So all of those kinds of things would be very, very important to us. And then debt management, you're trying to understand there's a balance out there. It's called leverage, finance word of the week number 2. Leverage, which means you're putting leverage on the business to get a little more out of it, which means debt. So you're adding a little debt to it, so everything doesn't have to be funded by the owners of the business out of their pockets. So you can borrow a little money and get a little more return because you put some leverage on your investment. But certainly there's a mix out there that is optimal, and there's a mix out there that's suboptimal, and there's a mix out there that's really bad. And it's different in every industry. It's different in every business, so I can't give you any platitudes as to what's right. But I would tell you that the ratios are clearly used to understand that. Now, profitability, are what we're selling it for more than what it cost us to build it? In other words, are we taking in more than we spend? Well, that's kind of important, right? But certainly you want to know profitability. You want to know how you're doing. Are you as profitable as you should be? And are those sales, are the sales high enough? Meaning, on the profitability, one of the first things that everybody looks at is your profit margin. So at the very bottom of your your income statement, they're going to say, hey, this is how much money they made. That's how much money they made as a percentage of their sales. Is that an appropriate amount? Wow. The next bullet point I have here is ROE and ROA. That just means return on equity. So if people put equity into the business, they wrote a check to become an owner in your business, are they getting an appropriate return on that check they wrote? So think about a bank who loans you money to buy a car and they charge you 5% interest. Their return on that investment is 5%. Right? Same thing. So when people put equity money at risk, which is clearly the most at risk in the business, if you think back to that hierarchy of preference, that the equity is at the most risk, so you would expect to get a higher return. Is it an appropriate return? Is it the right return? Are we doing well? Should we put in more equity? Should we not? The ROA means return on assets. So how profitable are you per the assets you have in the business would be another one. And then you could look at profit margin as kind of a return on sales, and one that I hear about frequently is a return on invested capital, which is equity and debt. So if you put them all in together, what's your return on that? So that's those would be really important things. And then lastly, the fifth leg of this stool is market value. Is how else would you know what it's worth if you didn't run a ratio? I mean, you know, I like, you know, our logo is blue and I like blue, so therefore it's worth, you know, $1,000 more. No. So, you know, most people will use some sort of a basic ratio to determine what a business is worth, what a piece of real estate is worth, what the worth of any typical business asset would be. So we've talked about what the categories are, what they use them for, what questions they're trying to answer, and now let's take a look at them. So if you look at liquidity, the two major liquidity ratios are the current ratio and the quick ratio. And I would tell you the simplest and the fastest and the one that people look at really real fast is the current ratio. And it's just current assets divided by current liabilities. And you want that to be as big a number as you can get, right? So you want to show that you have a lot of coverage of the current assets available for you to run the business in excess of the current liabilities of the business. And then frankly, what some people do to get to really what I would call really, really, really liquid is they take the inventories out. While inventories are theoretically liquid because they can be sold in a relatively rapid fashion, really, you know, I don't know how long a can of Airedale's hot sauce sits on the shelf at Kroger, but it doesn't turn over tomorrow. So eventually, you do have to sell it. So a lot of people are just trying to get right down to where they think the cash is, and they'll take the current assets, total current assets, minus inventories divided by current liabilities to get to the quick ratio. And they tell you similar things, but different. Most people use the current just because they're so easy, and then the real true analysts would get down to the quick pretty quick. Oh, get to the quick. I like that. Yeah. All right, asset management. I talked to you about inventory turnover, and you know, it is as simple as sales divided by inventory. Now remember, on these things, I'm not telling you to remember these formulas. I want you to understand what I'm talking about, because you can always go back to a textbook. You can always go back to the internet. You can always go to investopedia.com and find these things. I want you to understand why and what we're talking about. And I will when I show you how to do the homework, I'll refer back to this to show you how I would do that. So, you know, on the inventory turnover piece, it's sales divided by inventory. And really what that says is, how often does your inventory turn over? And you would have a different expectations of inventory turnover if you're in the high fashion clothes business versus the car business versus the grocery store business, right? But that inventory turns over. Now the reason I have a bullet point that says take in context is because the what's happening in a grocery store example is the milk, bread, and eggs at the back of the grocery store are turning over real fast. But some of the stuff up front is turning over real slow. So what we can calculate here by looking at financial statements is overall inventory turnover, but it really doesn't tell us by, say, department how fast the meats turn over versus how much the dry goods versus the canned goods versus the frozen goods, which any good grocery store would know what their turnover is in those categories and what they expect. Another thing on asset management, because clearly the accounts receivable and inventories are part of your current assets, and they're incredibly important to the working capital of the business, the ability of the business to meet its obligations on a timely basis and continue to operate. So people want to see how long it takes you to get paid. So if you issue an invoice, and most people, kind of rough rule of thumbs, but the vast majority of invoices would be dated 30 days. So if I bill it on September 15th, it's due on October 15th. And what the analysts want to know is how closely are you hitting that mark? Are you getting paid in 25 days, which means you probably got really good credit quality customers, and so they're learning about your customers and your underlying customers, which tells them about the strength of your business? Or are you getting paid in 45, 50 days, which means your customers are weak, or you're a sloppy manager, or something, right? And so all this would enter into the analysis done by particularly, say, a supplier or somebody like that that's trying to determine your creditworthiness. Now, on the debt side, your banks are going to want to know, I talked about loan to value, the bottom one, I talked about that a lot, but it's just what amount of the loan is of the value of the asset that you're using to collateralize that loan, to put up in case you quit paying, they can take that asset. It's different in different asset categories. And so, it might be 70% on real estate. Raw land is probably 60%. But on, say, owner-occupied commercial real estate, it might be 70%. On accounts receivable, which is a whole lot easier to collect on, it might be, 80% liquidation value of equipment. They might loan you 85% of the liquidation value, which means if I had to sell all your equipment in 90 days, which is pretty unrealistic, so you're going to take a pretty good haircut to sell it in 90 days, which would be the liquidation value, how much I would loan you some percentage of the liquidation value. And so these are very common and used frequently as it relates to how banks would look at the ratios at a business. Debt to EBITDA, we've talked about that before, but there's only so much debt that they would want you to have as a multiple of your EBITDA, and probably the most you would see is kind of a 4x. And so, private equity with a lot of capital behind it and a proven track record, you can see 4, 5, 6. I mean, some people will do 10, but I'm just saying, in a normal operating business, 4 would be about as high as you could imagine them going. So if I had $100,000 in EBITDA, somebody might be willing to loan me as much as $400,000. Right? Quite, it may be bigger than you would think, but that's certainly the way they would think. Now, they probably want to loan you 250 or 200 on that 100, but there are times when it could go up as high as 4. And so once again, that's a ratio. And this debt service coverage ratio is the same thing I call the fixed charge coverage ratio. It's the same thing. That's how much do I earn, and hopefully that's some ratio higher than what I owe. And that's why they would focus on the debt service or the fixed charge coverage ratio. Bankers would clearly do that. Now, on the profitability side, everybody is going to look at your gross margins and your profit margins. The gross margins is, what is my sales minus my cost of goods? So if I'm in my cabinet making example, if I sold a cabinet for $100, how much did it cost me in nails, glue, wood, paint, whatever, transportation? And it would be very different is what your expectation would be based upon industry. In the software business, it would be one thing, right? It'd be and it would be completely different gross margin expectation than a grocery store. Software, you don't really physically have to produce a whole lot. Back in the old days, before everything got to the cloud, then you just like, here's a disk, here you go. And how hard is it to produce a disk with some code on it? Really easy. So the margins are typically much higher in the software business and incredibly low in the grocery business because there's grocery stores on every corner, there's lots of competition, etc. So, but the gross margin percentage is, once again, what did you sell it for minus what did it cost you? And it kind of looks at something without the overhead, the real estate, or your debt service or your management salaries, just focused on the profitability of that. And then everybody really quickly, probably the number one metric that people would look at in business is EBITDA. And it's a non-GAAP measure, and GAAP heads don't like it, but that's what the world runs on, is EBITDA. And so they would just want to know what's your gross margin percentage, but there'll be some others in here they're going to want to know. I'm going to talk about on the next slide, but clearly they're going to know what your EBITDA percentage is first. And what's a good percentage, what's a bad percentage? Heck, I don't know. But I would tell you that if you use 10% as a rough starting place, but it will be different based upon the industry. But clearly it's just EBITDA divided by revenues, and that gives you your EBITDA margin. I get asked by financial analysts constantly, what's your EBITDA margin and what's your target EBITDA margin in the long run? How good can you get that EBITDA margin? And so it's something that the investing public and analysts clearly want to know. Profitability. Aha. All right, so profitability, people want to know what your operating margin is. So if you think about an income statement and you get to the operating profit line, I want to know what your operating margins are, and it's just operating profit divided by revenues. It is really critical because it, once again, much like EBITDA, will take some of the noise out of interpreting what the financial statements are trying to say. Profit margin the same. If you do net profit, personally, when I look at a company, I want to know what their gross margin percentage is. I want to know what their EBITDA percentage is. I want to know what their operating margin percentage is. I want to know what the net profit margin percentage is, period. And I suggest that you do the same because the other people out there are going to be doing the same. And then we talk about return on equity, which is as simple as net income divided by the equity that you have in the business. So what percentage, how much money are you making, what percentage return are you making on what you have invested in the business? So an operating profit is pretty simple. It's just operating profit divided by revenues. Net profit is just net income divided by revenues, and then return on equity is just net income divided by equity. Now, market value is something quite different. In a public company, what's standard is price to earnings ratio, or the PE ratio. Standard out of the book for a well-established public company is to focus on price or earnings, or the PE ratio. So that tells you how much in favor this particular business is to the investing public over something else. What does that mean? Well, it's in great favor. It would trade at a higher multiple. So if I made $1 million in profit per share, or let's just say, let's take that out. If I made $1 million in profit and I was trading at 15 times earnings, that would mean my business is worth $15 million. But if I'm only getting 10 price to earnings ratio, my business is only worth $10 million. And so once again, this price to earnings ratio is very, very, very standard and important in public companies. And what the right PE is like everything else I've said tonight, it depends. It depends upon the industry, the times, the market conditions, the size of the company. All of those kinds of things would tell you what the right price to earnings ratio is, but it will tell you how the rest of the world is viewing this business and its valuation. The most standard way that most businesses, and particularly privately held businesses, are evaluated are on EBITDA multiples. And the wildest, simplest, most basic is kind of 5 times EBITDA. Now, there's no hard and fast rule at all. It could be, if you're in a professional services business like a CPA firm where you are the CPA and you are the business, if you're selling the business, you're not going to get 5 times. You're going to get 1, maybe 2, if you're really lucky. But if you're an operating business with employees, assembled workforce, good customers, and the thing kind of runs without you, you can get more than that, right? Because certain individual is not critical to the long-term viability of the business. So an EBITDA multiple, just kind of rough, would be 5 times, would be what the business is worth. I mean, I don't know what they've taught you so far in B school. I don't know what classes you've taken, but that's what we're after. What's this business worth? And that's front and center, the key to life in the future, and understanding what the actual value of a business could be. Now, book value, which is obviously the book value, it's essentially net worth per the financial statements, and no one uses it. Sometimes they will use book value and bank valuations, but it's really the book value of the loan portfolio, and they will trade on some multiple of that. But for the most part, book value is seldom, if ever, utilized. Now, on to the homework. I'm going to show you how to do the homework and the answers. So it ought to be pretty easy. I just want you to do it and have it under your belt one time. And before I get to that, I'm going to say something. We're going to do some ratios in a table. It's just going to be an Excel spreadsheet. But when you're finished with it, and I'll say it again when I go through the spreadsheet, is that if you can plot those things, you see what the pictures tell a much better story. You can see what's happening in the industry over a period of time. You can see what's happening to this company over a period of time. And so to the extent that you can use these ratios, the return on equity is just one example over these years. What's happening to poor old Allied here is the industry seems to be getting a little better and Allied's getting worse over time, and so you would want to figure out why. Is there something I'm going to do about that? Okay? All right, now let's go to the homework. Anybody have any questions before we do that? All right. All right, let's get into this. And all I have here on this spreadsheet here is just a simple spreadsheet. This is in doc sharing on the course website. I call it course shell sometimes. It's essentially the same thing. It's just in doc sharing, and it's called Homework Financial Ratio Analysis Fall 2017. Go pull it down. And all it is I've got a 2016 over 2015 numbers. I've got a balance sheet that consists of my assets, my liabilities and equity, and then I've got an income statement, right? And so what, I must have asked a question. Roy, can you see the spreadsheet now? Sitting there talking about like, okay, great. So the point is that I've got this column of numbers that's 2016 and we're in 2015. It's just assets, liabilities, and equity to equal a balance sheet, and I've got an income statement here in millions, right? And then we're going to come down and we're going to calculate some ratios, right? So I've told you the key to life in a business is EBITDA, so how do I calculate EBITDA? I'll come to net income. Just put the equal sign in here, and I'll pull my net income number. Now, interest, I'm going to hit equal. I'm going to pull the interest number. taxes equals taxes. Depreciation and amortization, where is that? It's right there on the income statement. So if I then sum all of that, I've got the EBITDA for this business. And you notice how different it is from the operating income or the net income. It's a different number. The reason people don't like operating income is because it's got depreciation in it. And depreciation, while should theoretically represent the loss in value of the assets as they are used and consumed, it may or may not, and is an accounting convention subject to accounting rules that may or may not replicate the real world and the market conditions. So we have a lot of used trucks at times, and they'll be completely subject to the used truck market. So when we're setting a depreciation policy 5 years in advance, we don't really know what it's going to be worth, right? So it should theoretically represent it, but does not. So most people will go straight to EBITDA. So that's pretty easy, right? So I don't notice what happened in 15. Well, the easiest way is just to copy and paste. There, I've got my EBITDA for the prior year, right? Or, you know, we could just do the calc all over again, but it's pretty simple. So we know their EBITDA is pretty darn flat here. Let's talk about liquidity ratios. Now remember, I'm not suggesting that you need to know cold how to calculate these, because at least for my quizzes, they're going to be open book, open web, and you can just go find it. All right? So on the current ratio, it's current assets equals, let me find my current assets up here on the balance sheet. Okay. Total current assets, $1 million, divided by, I can find the slash, divided by current liabilities. Aha, now I've got an industry average out here for me to compare this to. That is extremely helpful. Now the quick ratio was a little different because we need to say equals, and I'm going to put a parenthesis around this because I'm going to take my current assets minus my inventories and put another bracket around that, divided, see the formula coming in up here, divided by my current liabilities. That gets me a number. Oh, wow, we're not nearly as good as the industry here, are we? Well, what about inventory turnover? Remember, that is, you know, 10.9 here. So inventory ratio, if you can't remember how to figure it, we can come back to the PowerPoint. We'll scroll up here and we'll come to, I think I had the, well, maybe I didn't have it in here. Inventory turnover, sales divided by the inventory, right? So you don't have to know it. You can just go look it up. So come back over here and I take equals my sales divided by and the inventory. And I'm turning over my inventory 4.88 times per year when the industry is turning it over 10.9. So this probably accounts for that downward decline that we saw in poor old Allied, right? But the key here is, unlike the first two ratios where we crossed over, these were all on the balance sheet. This is a crossover between the balance sheet and the income statement. Quite a bit different, right? And so then if I want to go to my days sales outstanding, what the heck did he say that was? So come back over here, and my days sales outstanding is my accounts receivable divided by my average daily sales. So I'm going to build another formula, and I'm going to say equals accounts receivable. Where is it up here? Okay, accounts receivable divided by my average daily sales, which is, I'm going to put another bracket around it. See, we put the bracket in here. Average daily sales is, that's my sales, divided by 365. And my day sales outstanding is, I'm collecting my invoices kind of on average at 46 days when the industry is collecting at 36. So once again, I'm not doing so hot. All right. Now, let's talk about debt to EBITDA. So my total debt. Let's see how we've got the balance here. We've got total debt right here, right? And I'm going to take my total debt divided by my EBITDA that I just calculated. Boom. Well, that's a bank number, and there's going to be a number in there that they're comfortable with or not. So it's probably that's a really good number. I've got EBITDA. Most people would have multiples above this, so it would be 2 times this number, 3 times this number, not 77% of that number. So it's pretty good. Now I talked about these margins down here that I said were so important. So I want to know what my gross margin is. So I'm going to go back up here to the income statement. And I'm going to say that my gross margin divided by my gross margin dollars divided by my net sales dollars tells me my gross margin is 67%. Now that's good. But the market is 50, so there's some good stuff going on with this company. It's not all bad. Now my EBITDA margin, once again, I'm going to come up here and I'm going to pull this EBITDA number that I've just calculated, divided by my sales, and that's 46%. Wow, what the heck's going on here? This is really something is different here. My operating margin, once again, is my operating income divided by my sales. My profit margin is my net income divided by my sales. Now, return on equity is how much did I earn divided by, I got to go back to the balance sheet for my equity. Total equity. All right. And then I'm going to say, once again, when I get down to the final thing, what really at the end of the day matters to me is, well, I'm going to take this EBITDA number times 5, and I think this business is worth roughly $6.9 million. Got it? Now, what the next thing I would do if I was an analyst is I would copy, paste, and now I have a trend. And I can also, because I've got my industry average out here, I can see how I'm doing versus trend. I can see how I'm doing compared to peers. And over time, I can put back that same analysis over here on my return on equity versus my industry and see how I'm doing, how I'm comparing over a period of time. That, and this thing that's blacked out and says, do not fill this in, that's just in case I wanted to make it harder on you. I had something else I could make you do, but I'm not going to make you do it. So don't fill it in and don't worry about that on your homework. So I've walked you through physically how to do it. Now for your homework, you just need to pull down this spreadsheet and do these calcs, put them into your Dropbox, and we're good. Anybody have any questions? Because I went through that fairly quickly, but I think it's fairly simple. And you can always watch the video as many times as you want if you didn't get it. Awesome. Okay, well, I think that's it, unless anyone else has any questions. Great. That's exactly what I wanted to hear. It's funny to me how many professors want to demand you figure stuff out, and I kind of feel like it's my job to make the information accessible to you and make you successful if at all possible. So that's it. Same way we try and run a business, make our employees successful if we can. All right. Thanks, y'all.